Welcome back to the Deep Dive. Today we're going under the hood of a legal structure that, for a lot of institutional investors, isn't just a document. It's more like a high-performance engine. We're talking about the legal architecture behind the Southern Europe Opportunities SICAV-RAIF.
Right.
And our mission today isn't just to, define some acronyms for you. We want to really get at how Luxembourg's legal framework creates this incredibly powerful and efficient vehicle for real asset strategies.
Yeah, and it's a vehicle that's really built for a purpose.
We're trying to find the legal secret sauce that makes this the go-to structure for deploying capital across Southern Europe.
And for the people listening, family offices, private equity, the big institutional allocators, understanding this is about seeing how you get speed and governance in one package.
Sure.
We're talking about sectors like hospitality, logistics, digital infrastructure. These are value-add plays. And in those games, the ability to move fast isn't just nice to have. It's often the entire competitive advantage.
Okay, so let's unpack this. We have to start at the beginning with the foundational structure. We've got to decode this alphabet soup first.
Yeah, let's do it.
What is a SICAV-RAIF? What do those letters even mean?
So it's essentially a legal hybrid. The first part, SICAV, stands for Société d'investissement à capital variable.
Okay, so investment company with variable capital.
Exactly. And that variable capital part is it's the bit we really need to focus on later. It's critical.
And the second part, RAIF.
RAF stands for Reserved Alternative Investment Fund. The word to zoom in on there is reserved.
Meaning?
It means it's strictly for well-informed investors, so it's not for the retail market. This is an institutionally focused vehicle, and the checks and balances are designed for professional capital.
Okay, so variable capital and reserved access. Our sources immediately point to one massive benefit of this combination, the umbrella structure. If I'm a fund manager, how does this umbrella let me, say, redevelop a hotel in Greece and buy a logistics hub in Spain at the same time without the two projects tripping over each other?
Well, the umbrella is just foundational for that kind of operational flexibility. It lets you create multiple compartments.
Subfunds, basically.
Exactly. Think of them as legally distinct subfunds, all living under one single corporate roof. Each compartment can have its own strategy, its own assets, and, this is crucial, its own financial and risk profile.
So they're firewalled from each other.
Completely. And for a value-add manager, that's essential. You can have, say, a high-risk short-term redevelopment project in one compartment with its own specific financing, while a stable income-producing asset sits totally separate in another.
That is elegant. And underneath all this, we're still talking about a corporate body, right? Like a society anonym or an SA.
We are. The underlying legal form is often an SA, which is a standard corporate structure that a lot of European institutions are very comfortable with, or sometimes an SCA, which is more like a limited partnership.
Yeah. But at the end of the day, the goal is the same.
The goal is the same. It's optimized to onboard huge sums of institutional capital fast. But we're really looking for the engine of deployment speed. We have to go back to that variable capital idea.
Right.
That is the single most important legal feature here. It's what enables agility at an institutional scale.
Okay, this is where it gets really interesting for me. Because institutional capital is not usually known for its speed. It moves at a glacial pace.
It does.
So how does this structure let you execute quickly when timing is everything?
It works by fundamentally changing a core corporate procedure. So when the SICAV-RAIF is set up, it starts with a pretty modest initial capital, maybe 30,000 euros.
Just to get it going.
Just to get it on the books. But from that moment on, any new capital that comes in from investors, any increase from new subscriptions, it happens automatically.
Automatically. What does that actually mean? You're saying it bypasses some legal hurdle.
It bypasses a huge one. It removes the need to formally amend the fund's articles of association every single time new capital comes in. Think about the alternative in a normal company. You'd need board resolutions, you'd need notaries, maybe shareholder approvals.
Paperwork. A lot of paperwork.
And delays. You could easily be looking at 6 to 8 weeks just to process a new tranche of capital.
6 to 8 weeks. In that time, a deal for a distressed logistics asset in Italy is long gone.
It's gone. That's the whole point. With this structure, the manager can see an opportunity, issue the shares, take the capital, and deploy it almost instantly.
So the capital inflows are aligned directly with the deal pipeline.
Precisely. It allows the fund to scale up a compartment and react immediately to a pricing dislocation in the market. Without that automatic mechanism, your competitive edge in Southern Europe, where you have to be nimble, just vanishes.
Well, that's the speed.
Yeah.
Phenomenal.
Yeah.
But speed without discipline is, well, it's chaos.
It's dangerous.
So if this is a reserved fund, and it's not under the direct daily watch of the Luxembourg regulator, the CSSF, what provides the governance, how does a pension fund know its money is safe?
That entire responsibility falls on the AIFM.
The Alternative Investment Fund Manager.
Yes. The RAIF operates under what's called an indirect supervision model. It is legally required to appoint a fully authorized AIFM. That entity is the governance anchor for the whole thing.
So the AIFM is the pilot.
AIFM is the pilot, and it's a pilot subject to very rigorous EU regulations. The RAF simply cannot exist or operate without one.
And the AIFM is carrying that whole regulatory load. What are some of those specific responsibilities that should give an investor confidence?
Oh, the list is comprehensive. I mean, you're talking regulatory reporting at both the EU and national levels.
Yeah.
Total transparency. They manage the fund's entire risk universe: market risk, liquidity, operational risk. They're constantly checking for investment compliance, making sure the fund sticks to its mandate.
And they're the gatekeepers for investors, too.
They are. All the AML KYC checks, investor verification, that's on them. And critically, they oversee the asset valuation frameworks, making sure the NAV, the net asset value, is calculated properly and fairly.
So if you're the learner listening to this, the key takeaway is you're getting the best of both worlds. You get a vehicle built for speed and flexibility, but it has this highly regulated third-party governance structure layered right on top.
It really standardizes the whole experience for the investor. It ensures every single deal follows a consistent, compliant, and auditable process. For major pension funds or sovereign wealth funds, that's not a nice to have. It's mandatory.
Okay, so we've covered the structure at the top and the governance in the middle. Let's move down to the operational layer. The assets themselves. The source has really stressed the role of SPVs, special purpose vehicle.
Absolutely. The SICAV-RAIF is the brain. The AIFM is the nervous system. But every single asset, the hotel in Athens, the data center in Milan, the apartment block in Lisbon, is held in its own SPV.
So another layer.
Another crucial layer, either domiciled in Luxembourg or locally in the country where the asset is.
And the number one reason for this is pretty clear. Risk ring fencing. Can you give us a practical example of how that works for a manager?
Yeah, it's fundamental to any value-add strategy, which by definition involves more risk. So imagine the fund is doing a really intense office-to-residential conversion in Spain.
Okay.
And it hits a snag. Major planning delays, construction costs go through the roof. All of those liabilities, the legal and financial problems, are trapped. They're contained within that one Spanish SPV.
They can't leak out.
They cannot. I mean, legally cannot spill over and contaminate the cash flows or the balance sheet of, say, a stable, perfectly performing logistics asset held in a completely separate SPV in Portugal. It protects the integrity of the whole fund.
So one bad project can't sink the ship. What's the second big reason for using SPVs?
It's all about the money. Project-level financing.
The banks.
The banks. Lenders are much because the collateral is crystal clear. For a value-add strategy, this is vital. It lets the manager customize the financing, the leverage, the covenants to the specific risk of that one project.
Right. So you might need, I don't know, flexible, high-leverage construction debt for one project.
That's 75% loan-to-value through one SPV.
But for a stabilized asset, you want cheap, long-term institutional debt at maybe 40% LTV.
Exactly. And you structure that completely differently at its own SPV. It stops you from mixing up totally different financing terms, which would be a nightmare for reporting.
Which brings us to the third reason.
Which closes the loop. Transparent accounting and reporting.
Because even if the assets are isolated, the investor still needs to see the whole picture.
They do. So all of those operationally separate SPVs, they all ultimately roll up into the umbrella RAF's consolidated financial statements.
You get both.
You get the best of both. You get the risk separation and clarity at the asset level, but you also get unified, comprehensive reporting at the fund level. The granularity for due diligence with the bird's eye view.
Okay, so let's pull all this together. We've got the four mechanisms. The SICAV-RAIF structure itself, the variable capital, the AIFM governance, and the SPVs. So what does this all mean for a strategy that requires active management in a market as complex as Southern Europe?
It means the legal architecture isn't just a passive box. It's an active enabler of the strategy. These four pillars work together to create something that is legally rock solid, but operationally incredibly dynamic.
Okay, let's review that alignment. First, variable capital. That enables rapid response, letting you jump on those distressed assets before anyone else has even called a meeting.
Right. Second, you've got the umbrella structure. That gives you the flexibility to dedicate capital to specific themes like urban logistics without contaminating your other strategies.
Third, the AIFM. That provides the agile governance that big institutions demand, strict oversight, but fast execution.
And finally, the SPVs give you absolute risk separation. A manager can run multiple high-risk redevelopments at the same time without worrying that one failure will cause a domino effect.
This synthesis really confirms it. The structure is the foundation that powers the strategy. It's what makes the fund nimble enough for these high-opportunity, high-complexity markets.
And structure itself becomes a competitive advantage, no question.
Absolutely. So our deep dive today really shows that Luxembourg's SICAV-RAIF regime was built for one thing: to meet that institutional demand for both absolute legal certainty and incredible speed.
And that's really the central takeaway for you, the listener. Don't just look at this structure as an admin flowchart. The variable capital, the umbrella, the AIFM, the SPVs, this isn't just paperwork. It's the fundamental engine that powers the whole investment strategy in markets where timing and risk separation are everything. They are essential to generating alpha.
And with that, a final provocative thought for you to mull over. We've talked about how important speed and risk separation are in this structure. So what unseen friction, or maybe what devastating delay, would be introduced if you took just one of these layers away? What if the automatic variable capital mechanism just wasn't there, or the AIFM's oversight vanished? Think about the ripple effect on deal sourcing and investor confidence. We'll leave you there to consider the power of legal architecture. Until next time.